Advanced Accounting 7 Investment in Stocks Differential. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, our email, and our phone, and this information is taken from the Advanced Accounting text from McGraw-Hill. We discussed in our last video the equity method. The idea that if an investor owns between 20 and 50% of the stock issued by a company, that investor has significant influence over the company. We talked about that in the last video, and now we have a new term, the second bullet point, which is a differential. The differential is defined as the difference between the fair value of the investor's share of net assets they purchased and the book value. We saw the difference between fair value and book value discussed in a couple of settings, including our discussion on consolidations. Why is there a difference? Simply that the assets are worth more than book value. And the other reason is that there may be goodwill that's unrecorded, and we're going to calculate and record the goodwill in this video. The way we account for this differential is if they are assets with a limited life, buildings, equipment, vehicles, where there is a useful life calculated, we're going to amortize or expense the cost of that differential over the remaining economic life because we paid something more than book value. However, if it's goodwill, we're not going to amortize or expense the goodwill. And in the last bullet point, the actual entry to amortize those limited life assets is to reverse the entry that we make when the entity has income. So we're going to debit or reduce income. We're going to credit or reduce the investment account. Flipping over to the Excel document here, we have equity method accounting for differential. So I'm assuming that Levi's Jeans acquires 40% of a company called Hollywood Jeans, and they pay $100,000. The book value of Hollywood's net assets, all their net assets, is $200,000. They have a fair market value of $210,000. So there's a $10,000 excess of FMV, fair market value, over the book value. Fair market value is greater. The cost to Levi, the check that they wrote, was $100,000. The book value of Levi's share of the Hollywood assets is $80,000. If I highlight on that cell, it's 40% of the $200,000 book value. The difference between their cost and their share of the book value is the differential. And we're going to account for that differential in several ways. As it turns out, this excess of fair value over the book value is attributable to two assets. One is a piece of machinery with a 4-year life, and the other is some land that's worth $8,000. The machinery is $2,000, the land is worth $8,000, and that's where we get that $10,000 excess fair value over the book value. As we learned up here, Levi's has a 40% share of that total. So 40% of the machinery is $800, 40% of the land is $3,200. So that accounts for $4,000 of the $20,000 differential. In other words, $4,000 of the $20,000 can be allocated to these specific assets. We'll get to their accounting treatment here in a minute. The difference between the entire differential and the amount that we were able to assign to Levi's is considered goodwill. So I've defined it as the fair value of the assets not specifically identified, and that's $16,000. Now, how does all this get treated from an accounting standpoint? As I mentioned before, the machinery that has a definite life of 4 years gets amortized over the remaining life, $200 a year. Land, by definition, does not depreciate or amortize. It has an unlimited economic life, so there's no impact. And finally, that goodwill, $16,000, does not get amortized either. So of the three, the only entry is to amortize this $800 machinery difference. And if we were to take 1 year's amortization and I click on the cell, it would be $800 divided by the 4-year life. And here's our entry. Again, it's the reverse of the entry we make when the entity has income under the equity method. We are going to debit to reduce income. We are going to credit to reduce the investment. And finally, at the bottom, our carrying value will change. Our carrying value will be the original $100,000 cost less that amortization amount of the differential to get $99,800. If I click on the cell, it's the difference between the $100,000 less the $200 amortization of the differential. And obviously, if we sold the investment, we would use the carrying value to calculate the gain and loss. Let's finish up the discussion by talking about some other issues with the differential. Impairment of assets, we've defined that on some earlier videos when the value of an asset permanently goes down. And a good example is you own software that becomes outdated because of technology. Its value is impaired. That asset's value should be written down in expense, just like any other asset. And if there's a recovery, that is, if the asset for whatever reason recovers its value in whole or in part, we do not recognize the recovery. We do not increase the value of the asset back up. That's to be conservative, which is a basic accounting assumption. If you have additional purchases, they're handled the same way. We add the cost of the new shares of Hollywood to the existing holdings of Hollywood, and we use the equity method to account for it the same way. We have income, and the investment goes up. If we have a loss, we have a loss, and the investment goes down. If there's a dividend, since we've already accounted for the income and loss, the dividend's just considered a return of capital. That's the end of Advanced Accounting 7 for our 1-hour courses on GoToMeeting.com. Not only in management accounting, but other subjects, you can go to our website and find out more. Our YouTube channel, Ken Boyd STL, all one word. For individual tutoring and live chat sessions, both one-on-one and in small group, using GoToMeeting.com. Here's our website, our email, and our phone number. Thanks very much, and we will see you next time.